Imagine walking up to, like, the most exclusive high-stakes casino in the entire world.
Okay.
You don't have millions of dollars to play with, obviously.
Right, yeah, most of us don't.
Exactly.
Hmm.
But you walk up to the front desk, you hand the manager a $500 cover charge, and in exchange, they just slide a briefcase across the counter loaded with $50,000 of their chips.
Wow. Okay, that's a wild image.
Yeah, and then they point you straight to the VIP tables and say, go ahead and play. If you lose it, well, that's our problem. But if you win, you get to keep 90% of the profits.
It sounds completely absurd.
It sounds like an absolute fantasy, right? Or maybe some kind of late-night internet scam. But in the modern financial world, this exact scenario is actually playing out every single day.
It really is.
So we have to ask, are these setups handing you the keys to the kingdom? Or is the casino rigging the game to quietly just drain your wallet? Okay, let's unpack this. We are looking at the notoriously ruthless world of instant funding prop firms.
Yeah, and it is a space that has just completely revolutionized how everyday retail traders interact with the markets.
Right.
To put it simply, a prop firm, which stands for proprietary trading firm, is a company that basically stakes its own capital for independent traders to use.
But there's a catch, right?
Oh, a massive one. Because the price of admission and really the psychological toll it takes to keep that capital is far more complex than just, a simple upfront fee.
I mean, I see the marketing for these companies everywhere. They're constantly promising this massive leverage. But before we get into those hidden traps you mentioned, let's just look at the sheer scale of what is being offered. Because the numbers in our source material are just staggering.
They really are.
What kind of money are we actually talking about here?
Well, the scale is exactly what makes this so captivating for anyone who has ever, wanted to trade but just lacked the bankroll.
Yeah.
We are talking about firms offering initial account sizes that start as low as like $625, but they have the potential to scale all the way up to a massive $4 million in capital.
Well, $4 million?
$4 million, yeah.
That is life-changing capital for just, like, an individual sitting at home in their sweatpants.
Exactly.
But I have to be skeptical here. I hear these astronomical marketing numbers, but is anyone actually getting paid?
Yeah.
Or is it all just monopoly money sitting on a server somewhere?
No, actually, the payouts are very real.
Really?
Yeah, if you look at a prime example in the industry right now, there's a company called Apex Trader Funding.
Okay.
Since 2022, they have distributed $598 million to traders.
Hold on. Nearly $600 million. Like real cash hitting actual bank accounts.
Real cash. And by late 2025, the data shows they were averaging $15.4 million in payouts every single month.
That is insane.
It's massive. And if you request a payout, they process it in 24 to 72 hours. So the money is very real and it is moving fast.
Wow.
Plus, the profit splits are incredibly aggressive. I mean, traders keep 80 to 90% of the profits they generate. In some specific scaling phases, firms even let traders keep 100% of the profits up to a certain threshold.
So you basically walk in, you get their money, and you keep almost everything you make.
Basically, yeah.
But what's the difference between this instant funding model and the older prep firm models I used to hear about? Because I remember, like, wasn't there always some sort of test you had to pass?
What's fascinating here is that exact distinction is the whole psychological draw of the instant part of instant funding.
Okay, how so?
Well, in a traditional prop firm model, which we call the challenge model, you have to prove yourself first. You spend days, sometimes weeks, trading on a simulated demo account under very strict rules just to pass an evaluation. And only after you pass do you see a single dime of real capital. Instant funding bypasses all of that. You pay a much higher upfront fee, and you get immediate day one access to trade for real payouts. You skip the evaluation phase entirely.
Oh, I see. So it is literally the fast pass lane at an amusement park,
Yeah.
but for financial markets.
Exactly.
You just pay a premium to skip the line. But hold on, I got to push back here. If the payouts are this high, and the barrier to entry is just paying a cover charge, why isn't every retail trader out there retiring to a private island right now? There has to be a catch.
Oh, there is a massive catch, and it all comes down to the brutal odds of survival in this ecosystem. The truth is, the vast majority of people walking into that metaphorical casino are being carried out on a stretcher.
Yikes.
Yeah. Let's look at the traditional challenge models first, just to, set a baseline.
Okay.
On a first attempt, the success rate for passing a challenge is only 5 to 10%.
Wow. Only 5 to 10% even pass the initial test to get funded in the first place.
Right. But with instant funding, where you skip the test entirely, the long-term trader washout rate is a staggering 87 to 97%.
Wait, what?
Yeah, up to 97% of traders ultimately fail and lose their funded accounts.
That is brutal,
Oh,
97%.
it's extremely high.
So if the upside is huge, the barrier to actually keeping that money is incredibly steep,
Exactly.
which naturally brings us to the financial reality of those failure rates. Let's talk about the fees,
Yeah.
because this is where the illusion of this like instant shortcut really starts to fracture.
Oh, for sure.
If I want a standard $50,000 account, what is that actually going to cost me up front?
So for an instant funding account of that size, you are going to be charged somewhere between $500 and $979 upfront.
Okay.
Now, compare that to the traditional challenge model for the exact same $50,000 account size. That challenge only costs $50 to $200 upfront.
That's a huge difference.
And often, if you pass that traditional challenge, the firm actually refunds your fee entirely.
Seriously. This sounds like buying a VIP gym membership where the upfront fee is absolutely massive, but the catch is you have to keep paying these like reactivation fees every single time you skip leg day.
That's a pretty good way to look at it.
I mean, logically, why would anyone pay up to $979 upfront when a challenge model is only 50 bucks?
Basically because of impatience
Hmm.
and the illusion of a single isolated cost. You know, people think, I'm a great trader, I'll just pay the 900 bucks once and I'll start making thousands tomorrow.
Right, the fast pass mentality.
Exactly. But that upfront fee in instant funding is a total mirage. True cost analysis requires evaluating the cumulative attempt costs.
Because they keep failing.
Yes. Because the washout rate is up to 97%, the reality is that most traders are not just buying one account. They buy it, they fail, and then they buy another one. And another one.
Wow. And the numbers really bear that out over a slightly longer timeline. Digging into the data we have, instant funding can actually cost 40 to 60% more over a 6-month period for traders who fail to hit consistent profitability within their first 90 days.
Yeah, that math catches up to them quickly.
And that extra 40 to 60% isn't just an accident. It comes from this really punishing combination of account repurchase fees after you fail, plus ongoing monthly platform fees, and just the cumulative cost of constantly hitting the reset button.
Right. And here's the real aha moment of this entire industry. For many of these firms, the product isn't the funded account. The product is the reset button.
Oh, wow.
Yeah, they are monetizing your failure, not your success. You are paying a massive premium to skip the evaluation, but without the discipline that the evaluation forces you to build, you are mathematically far more likely to blow the account.
That makes total sense.
And when you do blow it, the firm happily collects another fee to let you try again.
But wait, if 97% of people are losing their accounts, they aren't all just naturally terrible traders who have absolutely no idea what they're doing, right? The math sort of implies the system is actively forcing them out.
It does.
So what triggers the trapdoor?
Yeah.
What are these invisible guardrails that guarantee almost everyone fails?
It all comes down to the drawdown limits.
Okay, break that down for me.
A drawdown is basically the maximum amount of money your account is allowed to lose before the firm pulls the plug and takes the account away.
Got it.
In instant funding, the daily drawdown limits are incredibly tight. They are typically set between 3 and 6% of the account balance, and the overall total drawdown caps are usually just 5 to 10%.
Here's where it gets really interesting, because the data highlights a very specific lethal detail here. These are often called static limits.
Yes, that is crucial.
Help me understand that mechanism, because that really seems to be the main tripwire. Let's role play this. Say I buy a $50,000 account. What does a static limit actually do to me?
Okay, let's say your static drawdown limit is 5%.
Okay.
5% of $50,000 is $2,500. So if your account drops to $47,500, you lose the account.
Got it. So I have a strict $2,500 buffer.
Right. Now, imagine you have a great week. You make $10,000 in profit.
Nice.
Yeah, so your account balance is now $60,000. In a normal world, your 5% limit would recalculate based on your new balance, giving you like a $3,000 buffer.
Sure, that's how regular math works.
Exactly. But a static limit does not adjust upward with your profits. Your failure point is permanently fixed at that original $47,500 mark.
Wait. So even though I have $60,000 in the account, if I lose just a few thousand bucks on a bad trade, I could still be miles away from my original starting balance, but the firm liquidates me anyway.
Well, not exactly like that. The static limit is usually tied to the highest point your account reaches.
Oh, I see.
Yeah, so if your account hits $60,000 and your static trailing drawdown is $2,500, your new failure point moves up to $57,500. It trails your highest balance.
Oh, that's so much worse.
It is. If you drop below that new watermark, you lose the account. You can literally never build a deep safety cushion. You are always, permanently, just one or two bad trades away from losing everything, no matter how much profit you have actually made.
That is incredibly stressful.
It creates constant, unyielding psychological pressure.
Yeah, I mean, because of those tight static limits, it's like being handed the keys to a Ferrari, but you were told that if you drive over 30 miles per hour, or if you tap the brakes a little too hard, the car repo team instantly drops out of the sky and takes it back.
That is the perfect way to visualize it.
You have all this horsepower like up to $4 million in scaling capital, but you are forced to drive it through a school zone.
Exactly. And the firms enforce that school zone speed limit by explicitly prohibiting a whole list of trading strategies. If you break these rules, you don't even need to hit your drawdown limit. They just ban you.
Really? Like what are they banning?
They ban things like latency arbitrage.
Which is what, exactly?
Latency arbitrage is when a trader uses ultra-fast software to exploit microsecond delays in the prop firm's price feed.
Oh, wow.
So if the real market moves and the firm's software is a split second behind, the trader's software basically sees the future and executes a guaranteed winning trade before the firm's price even updates.
Oh, okay, so you aren't predicting the market, you're effectively stealing from the firm's software delay.
Precisely.
Okay, that makes sense. That's not really trading, that's just a tech exploit.
Right.
What else do they ban?
They prohibit martingale strategies.
What's that?
That is a gambling technique where you double your bet size every single time you lose a trade, assuming that eventually, you will win one and make all your money back.
Right.
In trading, that is a fantastic way to blow up an account in 10 minutes.
I can imagine.
Yeah. They also ban high-frequency trading, or HFT, which uses algorithms to place hundreds of trades a second. And you can't use grid trading or hedging, which basically means playing both sides of the market simultaneously so you never truly take a directional risk.
So basically, anything that relies on gaming the system speed or just aggressively doubling down on risk is completely outlawed.
Exactly.
They want you making clean, traditional, directional trades. And I get that. But there's one rule in the data that I really want to push you on because it seems completely counterintuitive to me.
Okay, what is it?
The consistency rule. The data shows these firms often cap your daily profit contribution at approximately 20% of your total profits.
Yes.
Hold on, slow down. If I hit a home run and make $10,000 in one day, the firm punishes me. That makes absolutely 0 sense. They take a 10 to 20% cut of that money. Don't they want me to make as much as possible?
It sounds totally backwards, but this raises an important question about what these firms are actually looking for. It is a tension between risk management and forced failure.
How so?
From the firm's perspective, a trader who makes 80% of their profit in a single wild trade is not a good trader. They are a gambler who got lucky.
Okay.
The firm is managing millions of dollars of aggregate capital. They need predictability.
So by capping my daily profit at 20%, what are they actually forcing me to do?
The consistency rule prevents you from passing an evaluation or hitting a payout threshold based on just one lucky spike in the market. If your target is $10,000, you can't just make it all on Monday and ask for a payout on Tuesday.
You have to spread it out.
Yes, you have to prove you can make $2,000 on Monday, $2,000 on Tuesday, and so on. It forces a slow, methodical, repetitive grind.
Which goes completely against human psychology.
It's
When a retail trader gets access to a massive account, their instinct is to swing for the fences. The dopamine hit of a massive winning day is why half these people are trading in the first place.
And that is exactly why the rule exists.
Oh, wow.
Yeah, the static drawdowns of 3 to 6% daily leave absolutely zero room for error, and the consistency rule denies you the dopamine hit of a massive win. It forces you to suppress your human instincts and trade like an absolute machine.
And if you can't do that,
If you cannot do that, you hit the tripwire, you lose the account, and you pay a reset fee.
man. So with so many hidden traps and such a remarkably high failure rate, how does a listener know if they are looking at a legitimate business arrangement or just like a slaughterhouse? How do you spot the bad actors in this space?
Well, if you're looking to try this, the data highlights a few massive red flags you really need to watch out for. The biggest one is sudden rule changes mid-account.
Meaning they change the terms of service while you're actively trading.
Exactly. If a firm suddenly alters their drawdown calculation while you're in the middle of a trade, or they introduce a new restricted strategy without any warning, they aren't just doing routine maintenance.
Right.
They are moving the goalposts. They are actively trying to force you into a breach so they don't have to pay out your profits.
That's shady. The data also points to withdrawal delays. We mentioned Apex earlier, processing payouts in 24 to 72 hours.
Right, which is the standard you want.
Yeah, so if a firm is making you wait weeks or coming up with these obscure technical excuses when it is time to actually cut the check, run the other way.
Absolutely.
There's also a major red flag around a lack of transparency regarding broker relationships. What does that mean in practice?
It means you need to know where your trades are actually going. If a prop firm won't tell you which broker they use to route their orders, or if their customer service is basically non-existent when the trading platform freezes and costs you money, your capital is not safe.
So it's actually happening in that case.
You are likely trading on a rigged internal simulator rather than live markets.
Oof. This really forces you to look in the mirror. I mean, I want to ask you listening to this, are you an experienced trader with a proven track record, or are you just hoping for a quick win? Because the data is brutal. If you don't already have a meticulously tested strategy, this isn't a training ground. It's an incinerator for your cash.
It really is.
It seems designed strictly for a very specific type of person.
It is. Instant funding is best suited only for veteran traders with proven track records. It is also highly viable for experienced traders who have previously failed traditional evaluations strictly due to time constraints.
Meaning what?
Meaning they have the skill and the risk management down, but they just couldn't hit the arbitrary profit targets within the 30-day window of a traditional challenge.
Ah, okay.
And of course, it's for those who absolutely need immediate capital access and have the iron discipline to handle it.
But the data specifically capitalizes the word "not" here. Instant funding is not recommended for beginners or developing traders.
Not at all.
For anyone still figuring out their strategy, the traditional challenge models, with their 70 to 90% profit splits, cheaper entry fees, and much more flexible drawdown rules, those are a far better training ground.
Completely agree.
But looking at all of this, the 97% failure rate, the massive cumulative fees, the invisible tripwires, I have to push you on this. Does the existence of these punishing rules mean the entire instant funding industry is just predatory? Is it a scam?
I wouldn't call it a scam, but it is a harsh meritocracy. The tools themselves, instant access to large amounts of capital, they are not inherently evil. They're just highly leveraged financial instruments.
Right.
Knowledge, and in this case, capital, is only valuable when it is understood and applied correctly. If a trader does not already possess a rigorously tested strategy before they pay that upfront fee, instant funding will not make them profitable.
It'll just accelerate the loss.
Exactly. It will only drain their wallet much faster than a traditional model ever could.
It is the ultimate double-edged sword. So what does this all mean for you? If we look back at where we started, walking into that exclusive casino, the tension is incredibly clear.
Yeah.
Instant funding offers unbelievable leverage. The idea of scaling up to $4 million in capital and keeping 90% of the profits without having to wait weeks to start trading is a massive legitimate draw.
It's extremely tempting.
But the reality check is that upfront cover charge at the door is just an illusion. The 87 to 97% washout rate, combined with those strict, static 3 to 6% daily drawdown limits, means that the cumulative costs of resetting your account will absolutely bury anyone who walks in there without professional level discipline. It is a fast track, but the guardrails are coated in ice.
That is a great way to put it. And if we really want to get to the core of the economics here, it leaves us with a final, rather provocative question to consider.
Okay, let's hear it.
We know that up to 97% of traders fail. We know that over 6 months, the true cost can be up to 60% higher because of the cumulative repurchase and monthly fees paid by those failing traders.
Right.
So if a prop firm's entire business model generates a massive portion of its revenue directly from the fees of the people who fail, are their strict static drawdown rules actually designed to carefully manage market risk? Or are they mathematically engineered to ensure you inevitably hit the tripwire, lose the account, and have to buy another reset button?
Wow. Are they managing risk, or are they engineering failure to feed their revenue stream? There's a brilliant question to leave off on. Next time you see an ad promising instant funding and millions in capital, remember the house always knows exactly what the odds are. Thank you so much for joining us on this deep dive. Keep questioning the fine print, keep digging for the true mechanisms behind the curtain, and we will catch you on the next one.